Today, we're diving into a topic that could save you thousands in retirement: tax planning. Specifically, we're going to cover Roth conversions, tax diversification, and crucial planning strategies for those of you that are within 10 years of retirement. Tax planning is one of the most critical parts of your retirement, but this aspect is often underappreciated by pre-retirees and even some advisors. Ignoring tax planning is a great way to potentially leave dollars on the table. By the end of the video, you'll be able to understand the 5 key things about tax planning that could make a huge difference in your retirement. Let's discuss how to avoid giving your favorite uncle less over your lifetime.
This is Retire Ready, where we break down retirement planning and make it easy to understand so you can live your golden years to the fullest. Planning your retirement starts now with your host, Kyle Hammerschmidt.
So let's begin by understanding tax diversification. And before I just jump into specific strategies, let's talk about why this is important when you approach retirement. Tax diversification is all about having different types of accounts that are taxed differently in retirement showing up on your tax return. This gives you flexibility in retirement to manage your tax liabilities and manage your tax returns. There are 3 main types of accounts when it comes to retirement and taxes. Number 1 would be your traditional IRAs and your 401ks, tax-free accounts like Roth IRAs, and then taxable accounts like brokerage accounts. Having a mix of these accounts allows you to control your taxable income in retirement, which can help you. The overall goal would be minimize your overall tax burden, avoid pushing yourself into a higher tax bracket, and then potentially reduce your taxes on your Social Security from being 85% taxable at your federal tax rates. In my experience, many pre-retirees face a tax surprise in retirement because they haven't properly diversified their tax exposure. And now I kind of want to move on to what are Roth conversions? Roth conversions explained would look something like this: is when you talk about the strategies of moving money from tax deferred to Roth, it can be a game changer for many retirees and pre-retirees if you execute it properly. So first, what is a Roth conversion? It's the process of moving money from a traditional IRA or a 401k over to a Roth IRA. You pay the taxes on the converted amount now, but future growth and withdrawals are tax-free later. Why would you even consider a Roth conversion to start? 1, tax-free growth and your withdrawals are tax-free in retirement. No required minimum distributions in retirement from your Roth IRAs. And then 3, potential tax savings if you expect to be in a higher tax bracket in retirement or if you think federal tax rates will go up in retirement. So example would be, I got a married couple under 65 years old with $2 million in 401ks and IRAs or tax deferred accounts. They expect to stay in the 22% bracket in retirement. The household files right now, married filing jointly, $168,000 of adjusted gross income, and they claim the standard deduction of $29,200. Again, for their marginal tax rate, it's 22%, and currently an average tax rate of 12.3. I define average as the total tax divided by the total income before all your Schedule 1 deductions. So as it sits today, the married couple has $62,000 of room inside their 22% bracket. A $62,000 Roth conversion would be taxed at 22% rate, and their new average tax rate would be 14.9% in 2024. Again, they're paying the taxes now, so it grows tax-free, and that income would be tax-free in retirement. The same married couple could actually go up into the 24% bracket and fill that up, doing $245,000 in Roth conversions. Their marginal tax rate would be 24%, and their new average tax rate would go up to 18.9%. So why would you consider building in Roth conversions into your retirement plan? It's all about how you pay the taxes. You want a detailed Roth conversion strategy. You want to be aware of IRMA and income limits. You want to be aware if you're married or single. And then Social Security and capital gains. Those are all things you need to be considerate of before you start executing any type of tax strategy around Roth conversions. And now I want to talk about specifically timing your Roth conversions. When should you do those? When's the best time to do those? The second crucial thing to understand is how and when. So what does that even look like? So there's a sweet spot for most households. And maybe that's early in retirement, before you start taking your Social Security and before required minimum distributions are forced on you. But it's not always like that. Another great time would be in down markets. You also want to run a detailed plan, look at future average tax rates when all your sources of income are coming in retirement. If you have seven-figure accounts, like 401ks and IRAs, doing them now might make sense to avoid the future tax traps. I would highly suggest looking for years when income dips, such as early retirement. Right after you retire, but before Social Securities and before required minimum distributions kick in. Or maybe years with like high deductions or low income. Another thing I want you guys to remember is the 5-year rule. So it's a little confusing. So you have to wait 5 years after a conversion to withdraw the converted amount without penalty if you're under 59 and a half. This rule applies to each conversion separately. Next, I just want to talk about how do you fit Roth conversions into your like overall tax strategy. So how do we integrate Roth conversions into your tax brackets and investments? It's really important to understand that you have to look at the broader tax strategy because Roth conversions are just one tool in tax planning or like one tool in your toolkit. So some other things you want to include is managing your capital gains and losses, charitable and giving strategies, your timing of your Social Security benefits, spousal planning for married couples, the order and the sequence of withdrawals from your accounts, your spending strategies in retirement, specifically, hey, are we going to like build a plan to where we could like spend more in retirement? So as a financial advisor who takes a planning first approach, it does make sense to like look at your overall financial picture first. So what you would want to do is consider your current and your future tax brackets, factor in state taxes, which can vary widely. Think about your legacy goals, like who's getting money after you. How many shares will you need to sell to get your net income? How much of your Social Security is going to be taxed? And like, is a majority of your money right now in tax deferred accounts with very little in tax-free and Roth? And so doing partial Roth conversions over several years to spread out the tax hit that might make sense. You might combine Roth conversions with like charitable giving to offset tax impact. You might even like look at coordinating conversions with Social Security claiming strategies because long-term that will help you keep more. You might use Roth conversions to avoid paying like $80,000 to $120,000 in Medicare premiums because IRMA. Remember, the goal is to pay the least amount in taxes over your lifetime, not just in any given year, or like, how do I reduce my tax bill this year? And then finally, I just want to wrap up with potential pitfalls to avoid. So when you're planning your retirement or your tax strategy, you can't forget about healthcare and Medicare and your IRMA penalties or like your Medicare premiums. So Roth conversions could push you into a higher modified adjusted gross income threshold, which then could cause you to pay more on your Medicare premiums. So you need to carefully like project your modified adjusted gross income when you're planning your conversions and expect it to go up now or later. And don't ignore like state taxes specifically because every state's different. Some states tax Roth conversions differently than others. So always remember like where you're at now and where you're going to live in retirement. Another thing that I see often is like maybe converting too much at once. So this could push you into a higher tax bracket potentially and negating some of the benefits. A great place to start is just like filling up your current tax bracket as it sits right now. This is just an example. It typically is way more of a strategy than just, hey, fill up your 22% bracket and you're done. But that's just a good starting point to kind of look at some numbers. Another pitfall would be just like ignoring Social Security taxation. Up to 85% of your Social Security can be taxable depending on your income. Roth conversions, while you're doing them, might increase the taxation of your benefits in the short term, but also save your Social Security from being double taxed once you're done with Roth conversions. So how do we take this information and like take some next steps? So I would suggest start by reviewing your current retirement accounts. What's the balance between money in your 401ks and your IRAs and your tax deferred accounts versus like Roth and taxable accounts? Are you on track for a tax efficient retirement? Next, like project out your retirement income and expenses. What tax bracket do you expect to be in retirement? Where are you at now? Like what happens if tax rates go up or down? How might this change over the course of your retirement? That's one thing I think most people miss out is like, how does this change over your lifetime? How much of your Social Security will be subject to federal income taxes because of like IRA distributions? Model different scenarios and then like optimize the strategy for the next 10, 20, 30 years. And I want to add a bonus section to this video. I want to add a bonus section here because I get this question. I just had a conversation. It's like, can I still do Roth conversions after age 73 when I'm taking required minimum distributions? The short answer is yes, absolutely. However, here's what you need to know. RMDs have to come out first. You must take your RMD for the year before doing any conversions. Required minimum distributions by themselves can't be converted. The RMD itself cannot be converted over to the Roth IRA. I'm going to say that twice. You can convert the rest. So after you take your RMD, you can convert any remaining amount into your traditional IRA. There's tax implications. Remember, you'll pay taxes on the amount you convert. So to kind of sum up the bonus section here, strategically planning your Roth conversions can still help manage future RMDs and can potentially lower your overall tax burden. There's no age limit. There's no age restriction on Roth conversions. That's another area of like confusion. So while it might be more complex, Roth conversions after 73 can be a valuable tool in retirement. So obviously, the earlier you start, the more options you're going to have. Even just like small steps now can make a huge difference over time. Tax laws can change; they will change, and so just keep up with the latest developments. Regularly review your tax returns and your plan and your strategy as needed. Remember, your goal or the goal of all this planning is to ensure you have more money to enjoy in retirement and to leave to your beneficiaries if that's important to you. By just understanding these key points about Roth conversions and tax planning, you'll be well on your way to a more secure and enjoyable retirement.
You've been listening to Retire Ready with Kyle Hammerschmidt. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon.